Deliverable inventory was approximately 100 million ounces on Friday, according to the Silver Futures Warehouse report that was just printed. Additionally, the official mood is one of relaxation and ease. Furthermore, I had no intention of creating this video. As we speak, I'm actually cleaning my kitchen. It's not the headline you're going to get if you just skim the usual noise, so I'm standing there staring at a mug that I should have cleaned yesterday and asking myself, wait, are we really about to do this again in the silver market? And you deserve the whole narrative, in my opinion. Here it is then. New York time is Sunday, February 8th. Tell us which day and time you're watching from in your comment. Before we go in, a little thing. I'm spearheading an effort to get rid of imitation channels. Subscribe and leave a comment for future Ledger Anna if you appreciate this type of analysis so the platform is aware of your support. The following weeks may be tense in ways that most people won't anticipate if you own silver, trade silver, or own anything related to silver, including coins, bars, miners, funds, futures, or anything else. Nor is it due to silver's enigmatic emotional nature. The reason is that the plumbing beneath the pricing is becoming constrained. I'm not claiming that the world is ending either. I'm not arguing that the transaction is bad. I'm not even claiming that anything must break. I'm suggesting that the calendar is not on your side and that the arrangement is out of the ordinary. I'll make it brief since I don't want this to become a bedtime story. Here's what I'm going to do for you. 3 items. First, the true and false meanings of the deliverable numbers. Second, why the breathless hot takes are less important than one date, February 27th. Third, the practical routes forward. The dull one, the tumultuous one, the one that no one is discussing. I'm checking too. We're filming. Yes, we are. Fantastic. Come on. All right, start with the topic that people debate online all day, stock. Someone may respond, there's plenty of silver sitting in warehouses. This may be accurate on the surface, but the silver future system includes classifications, so it may also be totally unimportant. You're essentially reading a restaurant menu and believing the food is already on your table if you don't comprehend the categories. Metal can be registered or be eligible in the exchange's native language. If it is in an authorized repository and satisfies the requirements, it is eligible. Although it isn't always available, it has genuine metal, bars, weight, and serial numbers. It's more like you can see that it's in a locked storage facility, but you don't have the key. Registered is not the same. Eligible metal that has a warehouse warrant issued against it is registered. Essentially the title document for the system, which enables it to be delivered through the futures process. When someone stands for delivery, you can really draw from that pool. Therefore, you should ask a straightforward question when someone waves a huge total inventory amount in your face. In reality, how much of that is registered? Without pleading with the owner, how much is truly prepared to pass through the delivery window? According to the most recent warehouse updates, the recorded pile is about in the vicinity of a little over 100 million ounces. There is no prophecy there. It's a snapshot. Tomorrow, it might be different. However, this is our snapshot. This is the point at which many people immediately lose their minds. They perform this theatrical math as if every contract equates to someone showing up with a forklift, and they look at open interest and the number of open contracts. It's not how futures typically operate. The majority of futures positions are either rolled or closed. Hedging is a big part of it. Spread trading makes up the majority of it. A large portion of it is simply people placing bets on direction and never wanting anything at all. Let me take 10 seconds to act like the adult in the room. Delivery demand is not the same as open interest. Taking that short path will intimidate you into making bad choices. However, and this is a major but, not everyone's delivery need needs to be significant. It must only be sufficient at the wrong time, when borrowing costs are already increasing and inventories are already low. We now arrive at the calendar. The first notice day for the March silver contract is February 27. If you're still holding the long side, you can now get assigned delivery. First notice day is essentially when the game shifts from we're trading paper exposure to okay. It's when the delivery method is put into practice rather than just being a theory. Not everyone accepts delivery though. It implies that whoever does, the system must be prepared. Consider it this way. You talk about a hotel most of the time, with a lovely lobby, a lovely website, and lots of reservations. However, the number of visitors who actually arrive at the front desk on the day of the first notification is far more important than the number of reservations that are canceled. Furthermore, March is not a haphazard month. One of the busiest delivery months in this market is March. That's why this date keeps coming up on my radar like a red light. According to previously released data, The March positioning is now big enough to consume a sizable portion of registered inventories if even a small portion represents metal, not inevitably, but enough to make them panic. Additionally, panic leads to poor pricing. Therefore, the question is not whether the exchange will expire tomorrow. What would happen if the demand for physical access increased during that delivery window while registered inventory decreased? Indeed, I mentioned sliding lower since the flow is another strange phenomenon. According to the vault data, metal has been steadily leaving over the last few months. Although each day is unique, the path has been obvious. Outflows don't just happen. Individuals are retreating. And at the current rate, you're talking about, on average, roughly 3-4 million ounces every day, give or take, exiting the system. Anna, I get what you're thinking. That sounds really big. It's enormous. I'm not here to hypnotize you, so here's the skeptical counter-argument. A bathtub with only one drain is not a warehouse. They resemble an airport more. Aircraft land and take off. There may be a week when there are a lot of departures and few arrivals, giving the impression that the airport is closing. After then, there may be a week in which the story completely changes due to an increase in arrivals. Therefore, the outflows are important, but what really attracts metal back in is the true question. And it typically boils down to trust, premiums, spreads, incentives, and rates. This leads me to the market for borrowing. The headline price isn't even one of the subliminal indicators of tightness. It's the price of temporarily borrowing actual metal. You borrow if you wish to deliver metal that you don't currently have, or if you want a settlement that goes smoothly. Additionally, the rate you pay functions as a stress gauge. Additionally, there have been instances recently of lease rates suddenly rising into the kind of high single-digit range that attracts attention. Under ordinary, dull circumstances, those rates are drowsy. They whisper instead of screaming. It's hardly evidence of the end of the world when they jump. It is evidence of competition for the same supply of easily accessible metal. To be clear, lease prices are subject to change for reasons unrelated to expiration. Financing costs may be reflected in rates. Positioning may be reflected in them. They may depict a short-term rush to get to a settlement. Once more, there is an adult present. A single indicator does not constitute a verdict. However, a picture emerges when you combine calendar pressure, low registered inventory, continued withdrawals, increased borrow prices, and indications. Furthermore, the image is not serene. I promised you new context, not just a warehouse soap opera, so zoom out now. Silver is more than just a dazzling item that people hoard. A functioning metal is silver. It is found in electronics. Electrical contacts are where it is. It is used in industrial operations. It's in sunlight too. Furthermore, solar is no longer a minor pastime. Late last year, the U.S. built double-digit gigawatts of additional solar power in a single quarter, and the pipeline is still full, according to latest industry updates. Additionally, a recent industry slide from National Labs states that the United States installed about 50 gigawatts of direct current solar power in the previous year. It's not a typo. That adds a whole new level of demand for wiring, parts, and anything else that comes into contact with the grid. It's even wilder on a worldwide scale. In a single year, the world added almost 500 gigawatts of solar power, according to one of the international solar tracking organizations. It's a large number of panels. There are a lot of links there. From underground to rooftops, that's a lot of metal. Does the amount of silver used in each panel now equal one another? No. The industry is always trying to cut back on utilization and be frugal. The idea, however, is straightforward. Because the volume is exploding, the unit intensity can decrease, yet the overall demand can still increase. And that's before electricity is even mentioned. Data centers, grid upgrades, EVs, and charging infrastructure all increase the need for conductive materials. Silver is one of the best conductors we have, but it's not the only metal in that tale. Also, the U.S. minerals data provides a clear, uninteresting, government-style overview of silver's use. Coins and investment bars receive a large portion. A significant portion is used for electronics. Additionally, a significant portion goes straight to photovoltaics. Because silver lives in two realms simultaneously, that mix is significant. The fields of industrial consumption and monetary psychology. Because of this, it can be peaceful for months and then completely untamed in a week. The just mine more crowd appears at this point, so let's talk about supply. Someone desired silver, thus a lot of it isn't mined. Silver came along for the voyage because someone else desired other metals, thus it's mined. This is made clear by the U.S. minerals data. The main sources of silver include operations involving lead, zinc, copper, and gold, and a significant portion of the resources are found in those polymetallic deposits. Translation: a surge in silver prices does not necessarily indicate that there will be an immediate supply of new silver produced worldwide. Yelling at a copper mine won't make it a silver mine. Mines react according to their own economics and schedules. Something else must change when demand increases and supply cannot keep up. It's usually the cost, it's substitution at times, stockpiles can move at times. In order to smooth things out until the real metal catches up, the paper market will occasionally perform acrobatics. This brings us full circle to the futures exchange and explains why February 27th is more than simply a trivia question. Because a mechanism for coordinating is the futures market. It is intended to facilitate middle ground interactions between producers, users, and traders. But confidence is also a key component. Assurance that the system can manage a delivery when someone wants to accept it. Additionally, you can be sure that the price you see is based on a genuine ability to source metal. Two completely different actions can be taken by the market when that confidence falters. People race to secure metal, which might cause it to spike. Alternatively, it might crash as a result of the exchange altering the regulations, tightening the margin, and kicking out speculative participants. Before anyone becomes upset, it is true that trades have the power to alter margins. They constantly do it. Actually, just recently, the public was informed about changes to silver margin levels and margin procedures, including actions that increase the amount of money needed to maintain positions. By itself, that isn't sinister. Risk management is that. However, there are drawbacks to risk management. Additionally, those with the most leverage are typically affected earliest by the adverse effects. The three paths I mentioned are listed below, and I want you to pay close attention because the best course of action for you will depend on how much suffering you can handle and which path you believe is more likely. The first path is the dull one. We begin the first day of notice. Demand for delivery is typical. What it needs is sourced by the system. Silently, eligible metal is registered, and it all ends up being a non-event. Silver swoops. Internet users declare triumph. After that, everyone starts debating something else. The second path is the chaotic one. Demand for deliveries is higher than normal. Higher, but not everyone. The registered inventory appears to be low. Lease prices remain high. Spreads get wider. The market begins to feel pressured. This volatility then reinforces itself. In that universe, paper prices fluctuate while physical premiums in some locations remain constant, creating a chaotic situation. That doesn't require the entire earth to run out. All you need is timing, logistics, vaulting, bottlenecks, and refinement. And path 3, a credibility event, the one no one wants to discuss aloud. At that point, paper and immediate physical silver are treated as cousins rather than twins by the market. Where the real-world transaction price is determined by your location, the speed at which you need it, and the person you are interacting with, and the futures price becomes more of a reference number. Sometimes we already see signs of that in other metals, and in previous episodes, we've seen it in gold, where some delivery points trade differently than others. It's not a work of fiction. It's what occurs when timing and place are more important than the price on the spreadsheet. Because silver doesn't reside in one location, this is where the geographical component infiltrates and destroys everyone's tidy spreadsheet. It resides in trucks, refineries, vaults, shipment schedules, customs paperwork, and someone's email saying, "We'll get it to you next quarter." Therefore, the actual price you pay may be one number plus friction, even if the worldwide price is just one number. And that friction has started manifesting itself in a visible way lately. In contrast to Western futures, Asian pricing has occasionally remained stable, then reacted, and then expanded once more, as if the market is unsure if it is tight or just uneasy. Since moving metal across borders is not the same as moving a stock from one account to another, some commentary has even highlighted times when the premium appeared abnormally high and the gap did not immediately disappear. You have time, money, approvals, bar formats, and occasionally regulations that make arbitrage far more difficult in real life. This is significant since the futures market caters to those who are unlikely to ever need delivery. I do not think so. That's the way these markets usually work. The majority of futures positions are closed or rolled instead of being physically exchanged. For this reason, the first day of notice usually goes smoothly. Even if the system is essentially solvent, It is stressed if an unusually large number of people insist on actual warrants in a brief period of time. The wild card is shown here. What happens if this time the marginal buyer isn't a speculator? What if the manufacturer is merely seeking assurance? Uncertainty is poison when creating anything electric on a large scale. Paper can be used as a price hedge. You cannot use a chart as a hedge if we are unable to obtain the metal by the required date. I keep returning to the same question because of this. Because the trading event burns hot and then cools, is it merely a trade event or is it a confidence event? For years, the confidence incident changes people's behavior. Furthermore, the headline price doesn't hint to it. It comes from the plumbing, as you can see. I'm going to now question an implicit premise that is now prevalent in a lot of silver discourse. It is assumed that the exchange must default if registered inventory is low and open interest is high. That is an enticing tale. Additionally, the system's buffers make it lazy. There is eligible inventory. When incentives increase, metal can be mobilized. Arbitrage does occur. Importantly, the majority of futures consumers do not desire delivery. Therefore, a discrepancy on paper does not always translate into a default in practice. But this is the reason I'm still listening. There isn't just one ratio that increases the likelihood of a credibility event. They have to do with behavior, recurrent delivery spikes, high borrowing prices, ongoing withdrawals, and growing mistrust. And indications of just that type of conduct have been observed. Silver, for instance, has seen significant fluctuations and a lot of attention from retail and leverage traders, indicating that the broader precious metals complex has been experiencing severe volatility and intense speculative activity in recent market updates. This is significant because little disturbances turn into major changes when a market becomes congested. Additionally, there have been reports of tightness in major trading hubs, with spot relationships occasionally moving versus futures and borrowing costs increasing. Once more, evidence that this is not a dormant market, not evidence of its demise. What are you going to do with this? First of all, avoid being addicted to conspiracy theories. Secondly, avoid being addicted to leverage. The two quickest ways to get your face torn off are those two methods. This is where people get wounded, so let's take a moment to discuss leverage. Silver is not a delicate metal. If you're over-levered, you won't be able to wait it out. It can move like a tech stock on caffeine. You are liquidated. Then, without you, you get to see the market perform precisely as you anticipated. Therefore, the question of where silver is heading is not the most pertinent one. How much of my money is at danger if silver does something crazy in the next 2 weeks is the most helpful question. Here's a straightforward, non-fancy way to think about things. Even a severe silver move can be survived if you have a modest portion of your portfolio in silver, say low single digits. Although bothersome, it's bearable. A violent motion is not bothersome if you have a large piece. It destroys identity. Additionally, when the market system is under stress, silver has a history of making severe fluctuations. It can be a squeeze at times. It can occasionally be a flush. Sometimes it's a change to the rule. There are moments when it's pure panic. Exchanges had tightened their controls during speculative run-ups in previous decades, and the price dropped precipitously. Memorizing the past is not the goal. Respecting the mechanism is the key. Rule and margin changes may cascade when leverage is concentrated. I have a question for you. Do you have silver exposure that is contingent on the promise of another person? Or do you have direct control over what you're holding? Furthermore, I'm not evaluating either response. The risk profile is different, which is why I'm asking. Funds, futures, unallocated accounts, and paper exposure can all be easily accessible and liquid. It can be traded in a matter of seconds. Storage is not a concern. However, in severe cases, counterparty and settlement risk may be involved. Additionally, paper can occasionally track the price while your real-world purchasing premium operates differently, even if everything else is flawless. Although they eliminate some counterparties, physical currency, bars, and designated storage increase friction in the actual world. Spreads, liquidity, insurance, and storage. Control is exchanged for convenience. And if you're asking yourself, well, Anna, which is better? It's not the right question. What problem am I attempting to tackle is a better question. Protect industrial inputs, diversify away from financial assets, speculate on prices, and hedge against inflation fears. They are distinct missions. Another query now. Is February 27th a peaceful day, in your opinion? Or do you believe we'll receive a major event? I really want to know how you're reading the tape, so please let me know in the comments. While we're discussing comments, let's talk about something that is more important than most people realize. If you're successful, post your success story in the comments so others can keep motivated. Let's now examine what might actually occur on that date. Practically speaking, there are particular procedures and paperwork involved in the delivery process for the future. I want silver, you don't yell, and a bar shows up. Notifications, assignments, warehouse receipts, and warrants transferring between accounts are all included. The registered category is important because of this. Warrants are important because of this. This explains why abrupt behavioral shifts appear in the data before they do in the news. The system has levers in case the demand for delivery is greater than what it anticipates. Due to increased margins, delivery may become more costly. Position limits may become more stringent. It has the ability to modify the rules regarding who can hold what and how. That can all reduce demand. However, it can also violently shake out weaker hands. And that leads me to a tiny but crucial bit of new background that many people overlooked. A smaller-sized silver futures product has been introduced by the exchange, which has also been changing contract design to alter how various players can access the market. Participation can be expanded with smaller contracts. They may also increase conjecture. Once more, structure is important. You may be asking yourself, is this bullish or bearish? The truthful response is that it depends on the route taken. The chaotic path can simultaneously be chaotic in the paper world and bullish in the real world, because even though physical premiums stay sticky, the paper price may decrease if the exchange increases margins. It isn't magic. In contrast to a commodity event, that is a credit event, nothing can be the dull path. The credibility path doesn't have to look like a Hollywood default, but it can be genuinely transformative. It may manifest as increased basis, spreads, financing costs, regional premiums, and a gradual change in the global perception of the reference price. Since this is important to understanding why the system is under stress in the first place, I would like to add one more layer of new information. Critical materials are receiving more attention from industries and governments these days. Supply chains have been brittle. The capacity for refining is limited. Furthermore, industrial demand is no longer merely nice to have. It is linked to manufacturing policy, grid resilience, and electrification targets. The market can feel constrained for extended periods of time when you combine that with the fact that a large portion of the supply of silver is byproduct supply. Even the U.S. mineral summaries mentioned that price increases were attributed to the fact that global consumption outpaced supply. It's not something a YouTuber would say. That is dull government jargon. What should you watch in the interim until your first day of notice? First, keep an eye on the trend of registered numbers. The trend, not the one-day print. Second, observe if withdrawals quicken or slow down. Trend again. Keep an eye on borrowing costs and the correlation between futures and spot in key hubs. The market is indicating that physical access is valuable if you see spot acting strongly compared to futures and borrowing costs remaining high. Fourth, keep an eye out for exchange risk notices. The behavior of the entire short-term population shifts in tandem with changes in margins. Fifth, pay attention to the rhetoric, because it may indicate that levers are being pulled behind the scenes to keep the machine running when the rhetoric changes from nothing to see to this is normal market functioning. Let me now present the cynical counter scenario that is less exciting and that no one wants to hear. It is possible that the anxiety associated with inventory is being overinterpreted. Eligible metal might be registered without any problems. The apparent outflows might not have been due to scarcity, but rather to logistical repositioning. The lease rate increase might have been a short-term financing glitch rather than a structural shortfall. Furthermore, a lot of March positioning might just be rolled before it is delivered. All of that is feasible. Therefore, your plan isn't a plan if it depends on the exchange breaking. It's a prayer. Furthermore, prayers are not a way to control risks. You don't need to forecast a collapse, though, if your strategy is to just comprehend the pressure points, stay out of leverage traps, and manage your exposure to withstand volatility. All you have to do is respect the arrangement. Furthermore, the setup is intriguing. Let's face it. The first day of notice is quickly approaching. The amount of registered inventory is not very large. There is a real industrial demand. Additionally, market structure is currently sensitive. Here is my workable framework. First, decide what you want to achieve. Are you using days to trade a move? Are you making long-term investments? Do you have any other hedging interests? Put it in writing, because the market will write it for you if you don't. Define your risk in step 2. Choose a size that will allow you to sleep. You're too big if you're looking at your phone at 3 in the morning to check prices. Define your instrument in step 3. Don't act as though you can manage counterparty risk if you can't. Don't act like you can manage storage and liquidity friction if you can't. Choose the compromise that you can tolerate. Define your trigger in step 4. What would cause you to reconsider? An increase in margins, an unexpected surge in demand for deliveries, or a reversal of warehouse trends? It's not conviction if you wouldn't change your mind. That's being obstinate. This goes beyond silver nerd drama, so I want to zoom out one last time. This has to do with having faith in price signals. The physical availability and the paper price remain linked in a healthy system. Because arbitrage is possible and the market clears, they can briefly diverge before reconnecting. That connection phrase appears in a stressed system, not because someone made the decision, but rather because of bottlenecks, regulations, financing, and logistics. When the connection weakens, people begin to pay for certainty. They cover the cost of prompt delivery. In the proper place, they pay for metal. They cover counterparties they have faith in. Therefore, metals are inputs, so if you're watching this and wondering, why should I care if I'm a stock investor? Due to the materials-intensive nature of the energy transition. Because supply chain limitations that affect one metal can also affect other metals. Additionally, markets frequently disclose stress in one area before it manifests itself in the indexes. Now, I'll tell you if you're wondering. So, what's the one thing I should not do? A stop loss and a prayer won't be enough to beat a volatility spike. Stops turn into gasoline in a fast-paced marketplace. They set you off, not shield you. Additionally, don't assume that the exchange has a single lever. The playbook may contain settlement nudges, tighter limits, or larger margins if stress increases, which would make the trade less appealing right away. That has no bearing on the number of panels constructed or circuits soldered. It only modifies the duration and who can bear the risk. For this reason, until this window closes, I'm keeping a close eye on the price as well as the regulations, the flows, the tone, and the official announcements. All right, let me bring this plane down. On a real calendar, February 27th is a real date. March delivery has real mechanics and a real process. A legitimate category with a legitimate meaning is registered inventory. Furthermore, industrial demand isn't a trend. It can be measured. However, none of this ensures fireworks. All it does is increase the likelihood of volatility. And volatility is the punishment meted out to those who are ill-prepared. So here's my ask. Subscribe if you don't want the copycats to succeed. Leave a comment for our future ledger Anna and forward this to someone who still believes inventory is just a number, and explain this to me. Do you believe a forced flush down or a squeeze up would be the bigger move if the market goes crazy on the first notice day? There are good arguments on both sides, so I'd like to hear your opinion. Okay, I'll go wash that mug and return if the warehouse numbers start to show some unusual behavior. I have to say this one last time, this instructional material is founded on openly accessible market data and a broad understanding of the industry. Personal financial advice is not what it is. I'm not familiar with your goals, circumstances, or level of risk tolerance. Conduct independent research. If you need a qualified professional, speak with them. Don't wager money you can't afford to lose neither.